Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, December 30th, 2020. What I want to cover in this video is commodities. We're going to look at various commodities, the agricultural commodities. We'll look at a few other, oil, natural gas, things like that. So I won't spend too much time on any one particular commodity, but I do want to reiterate that's where, I think some of the best risk-reward profiles are right now and have been for months. I've been stated that for a while. As far as investments, long-term trades, that's where I feel much more comfortable from both a fundamental and technical perspective. And I'm really referring to, other asset classes such as stocks. Yeah, the trend in the stock market is certainly up right now. It's an uptrend. But again, it's the technical posture, other things I've mentioned there, and largely the fundamentals. Like I've said recently, this is the only time in history, I believe, that we've had the economy's in a recession. Both the Federal Reserve and the U.S. government believe that things are bad or going to get worse. Otherwise, they wouldn't have Fed wouldn't pledge low rates throughout the year, zero rates, zero interest rate policy, another stimulus package passed. Yet the stock market's all-time highs. That is a disconnect of fundamentals. And you can look up valuations, pull up the Shiller P ratio, do a Google search, see what's where stocks are valued. So again, it's all about again, I'm speaking longer term here. I'm looking out, 6, 12 months plus. And again, an uptrend in the market can last, overvalued, can become more overvalued, more overbought. But again, and do you put everything in commodities? Do you put everything in cotton or oil? No. Do you put it all in the stock market? No. You diversify, and then money managers will overweight or underweight certain asset classes in certain sectors. So, if nothing else, these are trade ideas. It's not a comprehensive put all your money in commodities thing. But just want to kind of give an update on this from time to time. I like to do a broad-based coverage of the commodity sector. All right, let's dive into the charts. I'll cover the commodity ETNs or ETFs first, because that's, I know, where most people, the majority of traders don't trade futures. But keep in mind that most of these commodity ETNs that I'm going to cover, if it's coffee or wheat or cotton, they are ETNs that track the futures of a particular commodity. That's how they are tracking prices, and most do a pretty good job. They're not perfect. Given choice of the two, I prefer to trade the commodities, but again, some of you don't have commodities accounts, the experience or the capital requirements needed for those. Those are highly leveraged contracts, the futures I'm talking about. Whereas these ETNs, you can buy one share at zero commission at your broker. So like with cotton, for example, it's about 45 a share. You can go in as little as $45. Not that you need to, but again, it's all relative to your position size. If you're starting out and you only have a portfolio value of $5,000-$10,000, then you can take a shotgun approach to these commodities. That's what I like to do. Spread it out. Maybe overweight the most bullish ones, underweight the most bearish, or avoid them altogether. Okay, back to the charts. Cotton, it's in an uptrend, and what I'm noticing on a lot of these commodities, I've been bullish throughout most of the year on these, is that many of these are now taking out their previous reaction highs, and that is bullish. We've been in a bear market, a cyclical bear market for years in commodities. Most commodities for the last several years have been falling in a downtrend. A downtrend is simply a series of lower highs and lower lows, whereas an uptrend is a series of higher highs and higher lows. Now, is it can we say definitively that the bear market is over in most of these commodities and a new bull market's begun? No, that only time will tell before we can definitively say this is a new bull market. But I can say that the charts have been constructive and continue to look good. Cotton, I'll just move on, say that there are negative divergences, but I talked about that recently. We've seen quite a few commodities, and this is a signature of a bull run where you have negative divergences. We had it right here, for example. I'm showing you a point where there were divergences on the indicators, yet cotton, in this case BAL, the cotton ETN, continued to power through and shrugged off those divergences. Maybe a little minor correction there. And so I will point out there are divergences. We are coming up to resistance. You're getting a little overbought here. But again, overbought in a bull trend tends to become more overbought or stay overbought for a while. So there's cotton. And if nothing else, if you're in it right now, and you want to know an objective level to place a stop, well, here's an uptrend line right there that if broken, and I'm going to move this support level down here to these reaction lows. So you can see levels on the charts, and would I add to cotton right now? No, it's kind of towards the top of this channel right here. There's that divergence. Maybe on a pullback to the trend line, also 42.90 with support, and you can also set a stop below that level because that is price support. So you have 42.90 in the trend line there, if you're concerned. And if you're a longer-term investor and you are of the mindset that this is quite likely the early stages of a new bull trend, then no need to run tight stops. You can allow for corrective waves within a larger trend, because again, if it is a bull market, then we're looking at probably many months, if not several years of gains to come. A lot more upside in many of these. So there's cotton, constructive that it's in an uptrend. The divergence is right there. Give you some levels and to watch below. SGG is one of two sugar ETNs that I track, constructive as well. This one hasn't, as an ETN, taken out the previous highs, but maybe we'll look at sugar futures here in a second. We had this uptrend line. There's an example, whereas more active swing traders or even trend traders that are more active can micromanage. You had a uptrend line there and then a breakdown. That's a sell signal. So you may have stopped out or or at least not added to your position there. It was about a 6% drop, but it's powering back up. So again, we had divergences at that high. That was that. Basically, that second target was around $47, effectively hit, maybe a hair under. Corrective wave, and we're powering back up. Pretty impulsive so far. So big level to be taken out. And again, you'd want to correlate this with also sugar futures. That's symbol SB for sugar futures. But about the we'll call it about $49 level. You can see these previous reaction highs, 1, 2, 3 right there in SGG. And then the other one is Cane, just a different company, also tracking sugar prices. But you can see different levels on this one. And there's your uptrend line to watch. We had divergences right here at this recent high, but played out for a minor correction. Boom, went on to take out that previous reaction high. That's constructive. That's bullish. So I like what I'm seeing there. The indicators, the PPO is above the zero line. That's bullish, denoting a bullish trend. The dashed line is your zero line. Bearish when the lines are below, like right here to here. You can see a bearish trend from there to there. And then we put in at the bottom there a beautiful inverse head and shoulders bottoming pattern. Left shoulder, head, right shoulder. Again, this was pointed out back at the time. Neckline, boom, breakout, and that's it. This one is clearly in an uptrend right now. So again, I place, just somewhere to consider some of your funds. Cow, this is the livestock ETN. It has both lean hogs and live cattle. And and I've said this before, I've been most bullish on the grains for the last, 3-6 months or so. And typically that doesn't help livestock. That's an input for the farmers to they've got to feed the livestock, and so rising grain prices can put pressure on livestock. So it's what's happening is I'm seeing a broad-based rally in agricultural commodities. So it hasn't knocked this ETN down, but it's been locked in the sideways trading range right here between about 34.90 at the top end to 32.85. And you can trade the range as long as that lasts. There is a downtrend line, and we could get a breakout here. If we see a lot of interest in commodities, you can look for a breakout. The 34.90 is there, and the trend line's a little bit above. So you'd want to see the trend line taken out, in my opinion. And then you can see the next targets here. Downside, well, there's your support level there and there. So this one I'm neutral on right now. I'm not as keen on that, especially with the grains running right now. And again, I'm going through these in no particular order. I have a watch list that is off on another monitor I'm clicking on now. It's just the order I have these ETNs in. So this one's not related to the ag commodities. This is UNG, natural gas. I covered this recently. There's your positive divergence on the daily chart. I was posting a chart of NG. Let me find that for you. Natural gas futures. The other day we had a big drop after it had been falling for a while, so we got extremely oversold. I mentioned it, I said there wasn't a hard buy signal, but if you wanted to step in for a bounce trade, I gave some potential targets. First one was at 355. We were right here the other day. That target was hit, and then I said the trend line would be your next target, and then the 2511. Look at this perfect tag of the trend line. And as a matter of fact, I updated this yesterday. Let me give that post here. This was in the under yesterday's post. I said downtrend line, which is the second target on natural gas, has been hit with the 2511 gap resistance level just above. This is an objective level to book quick one-day profits of about 8% for anyone that took it. Let's see, you can't see this chart for some reason. I need to pull this down, 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 down. There we go. So that was it. We had a perfect tag of that level, posted at the time. Good opportunity to get out, book your quick profits. And again, going back to that, if I can find it here, natural gas, there it is. That's it. So that was where we hit it yesterday when I posted. We pulled back, we hit it again. I have not modified this trend line. Just a great example of how the technicals are working here. We've had two tags, two opportunities to exit. Obviously, the first tag, you're at higher levels. That's the thing about downtrend lines. They come in lower and lower each day. So the second tag, another rejection. That helps to validate the trend line. Again, there were a lot of reactions on that trend line, and that's why I said the other day I think it may come into play again, even though we had gapped down below it. And so it works the other way as well. If we take that trend line out, that's going to be bullish, and that would then spark a rally most likely to that next target, the top of the gap around 2511, and so forth and so on. On natural gas, let me jump over to a longer term chart here. Okay, this is a long-term chart of natural gas futures, nat gas weekly. This is from stockcharts.com, this chart right here. So you can see we're going back to 2006, and it's kind of simple stuff. I look for these for a bullish run after an extended downtrend. I like to see positive divergence on one or both indicators. I'm using the PPO and the RSI here, and that's again what triggers these major. These are the major rallies, even within a bearish trend. And believe me, on natural gas, a bear market rally can put in easily triple-digit gains, 100% plus on these counter trend rallies. It may not look like much, but you can see the arrows, the buy points. Look for oversold conditions. That's a move down to the 30 level here on the RSI, as well as this positive divergence. And that's what we had recently in July, and it's been an uptrend since. So well, the reason I'm covering this now, I mentioned on that trade the other day, if you took natural gas, on those extreme oversold conditions, and you want to let it run, this may be just a simple correction in an uptrend with more upside to come. So you could, at this point, if you didn't book the quick profits on the tag of that trend line, at least raise stops to entry for a break even, or raise stops higher than that for to lock in a profit if you want to trade and hold this one for more upside. And once again, if you don't trade futures, you always have UNG is one of the ETNs to trade natural gas, probably the most liquid one. There's your downtrend line, positive divergence as I mentioned. So, these are your levels to watch. And the way it works is if and as each of these levels are taken out, it should open the door for a move up to the next one. Those are all potential targets there for UNG. This is PLL Palladium. It's in my commodities watch list. Moving sideways, not much to say about it now. I do think the bull run is, I believe, over in palladium. The primary use, over 50% of palladium is used for emissions control in combustion engines. And we all know there's been this huge move towards electric vehicles. So I can only imagine demand has and will continue to fall for palladium. In recent years, there's been shortages that caused a big run up. So I think this one's overdue. In other words, I think this one's setting up and probably peaked back here in early 2020, earlier this year, and is poised for what could be a very, very nice bear market in the years to come. But right now, it's going sideways, so I can't make heads or tails of the chart. I can't make a case to be long or short. If you're in it, you're just going to get grind around until this resolves. So let's move on to the next one. USO. I think that USO is at best a dead money trade if you're long. and maybe an attractive short here. I don't think the risk reward is attractive. You're up. This was a major level back here. USO, I'm sorry, I should have mentioned this is a crude oil ETN, one of the most liquid. Had a big level back here that it broke earlier in the year and plunged down into the the lows here back in late April, it looks like, and came up. And it's just been in a multi-month trading range. Now it's near the top of that trading range, which says, if you're bullish, long-term bullish on crude, we broke above it, but the breakout, we haven't gone anywhere. But if you're long-term bullish, you would have to be bullish on, I believe, on both the economy and the stock market to be bullish on crude, because they tend to move together. But I think crude being at the top of the range, if anything else, the next move is down here to the bottom of the range. I think crude will probably continue to be dead money for a while. There'll be swing trades to make, but I'm talking a long-term trend investment. And remember, things like crude or all commodities, they don't pay dividends. So if you're in something that's moving sideways, you're not getting any return on your money. So I don't see right now a trade to be made. If I look at the 60-minute chart, I haven't even updated this one in a while, but we put in a divergent high recently. There's a trend line right there. That trend line needs a break if you're looking for a short trade on crude. And again, I haven't updated in a while. I'd have to pick some targets for you there. I can see some resistance or support right there, about 3170, and maybe there's a gap down here, something like that. But it's not one of my favorites, so let me move on. But I would be more prone to get ready to short crude on a break of this line. I'd have to look at crude futures as well. You know what, we can do that. Why not? That's what this video is all about, covering commodities. Some people might be interested in crude. Here's my CL 60-minute chart. CL are crude oil futures. There was a nice clean bearish rising wedge, broke down recently. And a lot like the stock market, remember we got some sell signals a week or so ago on the market and the major indexes, but they haven't panned out. This is what happens at the end of the year. Trading gets a little wonky. That's why I normally take the last couple weeks of the year off. Even if I'm not going anywhere on vacation, usually take the wife and kids, go somewhere. But this year we're around, and that's why I'm doing these videos in updates. But negative divergence breakdown, and by all counts, this is a bearish rising wedge breakdown. It hasn't played out that much, and I think we come on down here to either or both of these targets. It just may take till after the first of the year, once everybody comes back from vacation and the markets pick a direction. So that would be my preferred scenario on CL right there. I can't make a screaming case to short it. We had the breakdown. It is a snapback rally, but again, we're just kind of floundering around here, and that's what happens at the last few trading days of the year. Window dressing, tax loss selling, but also inflows into 401ks. There's a lot of cross currents, and that's why you get these choppy, sometimes directionless trends for the last couple weeks of the year. UGA is the ETN or ETF actually for gasoline. So if you want to trade gas prices, maybe own a business, you want to hedge up in case rising gas, if you have a fleet of vehicles and you could want to hedge against gas price rises, you buy this one, you can short this one. If you're just a pure play trader, there's your move right there. A break of this trend line would trigger a sell signal on UGA. Again, that is the gasoline ETF, and you can see some levels. Just target these gaps. That's what traders look for on things like this. And you'd also want to look at futures as well. But there it is. There's some levels to watch. Your trend line to break to trigger a sell signal. I'm sorry. There's your negative divergences. That is a 60-minute chart. Daily chart looks like this. That uptrend line probably. Yeah, let's tighten it up to match that 60-minute trend line. There it is right there. All right, next up, SOYB. Again, this is where I need to clean out some of these lines. I have a lot of lines, but it's just been a heck of an uptrend. Just to kind of recap, way back here, pointed out the time we had this divergent low, big positive divergence had been building, and right back here we had a little downtrend line. I mentioned that breakout right there, and said that was an objective long entry. So from there, soybeans have climbed. And that was back in May, about a 41% rally. So again, this is where, I think the opportunities are, because the charts look better and the fundamentals look better. Like I said, we're multi-year bear market. I know that there's inflation in the economy more than the Fed states. I believe that. I think a lot of people do. And remember, the Fed, all global central banks have just injected so much liquidity into the system. And yes, stocks have been a big benefit of that liquidity, but that money is going to find a home somewhere else, and it's starting to. And this is, again, to me, this is why I'm doing the video. This, you can say it's a bear market rally. You can say what you want, but it doesn't. This looks like bull market, early bull market action to me. That's a pretty powerful rally. These were little bear market rallies along the way. These little kickback rallies, but this has been a impulsive move. And again, when you go back for many years, you see, there's a lot more upside if it's again, if this is a new bull market. And this is a weekly chart right here of SOYB, and this is a case I've been making. There was a positive divergence back there, turned out to be a bear market rally, but it was a pretty powerful one. And yeah, it looks like this, although this one's more powerful. Again, ultimately, one of these divergent lows will prove to be a bear market rally. Commodities, I always say this, Apple, one day in the future, not going to be today, tomorrow, or next week, but one day in the future could be gone. There's been great companies that have gone to the wayside and just, died a slow or fast death. Any company could technically go to zero, any stock. What company? Commodities don't go to zero. They don't file bankruptcy protection. It's always value. There's always going to be a demand for soybeans, wheat, corn, as long as humans walk the earth. So that's where I see a lot of value again, because these are beat down, and I think other people are starting to see that and saying, hey, even if stock market's roaring, even if that's where my 401k is doing good, maybe I should start taking some of that money off the table, book profits, and put it into things. And that's where you're seeing other assets like Bitcoin and other things rally. And gold's had a heck of a rally. It's still in a bull market. It's been in a corrective phase for a while, but those are all different asset classes, different ways to diversify, and this is one of them. So just a great looking chart, like I said. And not just that divergent low. What made it different this time is you took out this longer term primary downtrend line here. So this breakout or this move up off this divergent low was different right here than this one, because we had a breakout of a primary downtrend line, and boom, there you go. There's going to be some resistance coming into play soon, but this is still a longer term target I laid out, I think, all the way back here, that about $22 level there. All right, so that's soybeans, and again, we're going in no particular order. JJG, I've covered this one in the past many times. I said if you want to, you don't want to try to micromanage or manage a portfolio with soybeans, wheat, and corn. By JJG, you get all three. That's what it tracks. It's the grain ETN, and same story. This is just beautiful display of technical analysis. This was a bullish falling wedge pattern, just as this was a bullish falling wedge pattern, and just as this was. And they were confirmed with positive divergence, which you like to see. So back here, that was good for a rally of about 24%. This one was good for whatever it was. I'll move the line if I grab right there, so I'm going to skip that. But this one here, what you had is sometimes you break out of a bullish falling wedge and that's it. You never look back. And sometimes you break out like you did here, and you come in and you back test the wedge at a lower level of the downtrend line. And that's what happened here. Since that back test, which was your second and last objective entry in JJG, it's up 41% in just a matter of about 4 months or so. Where does it go? Well, again, I think the case can be made that this is early stage bull market action. So there are going to be corrections along the way. Don't get me wrong. Right now, do you buy it? Well, probably not. No, it'd be like buying the stock market. You're just chasing a rally. I can't make an objective case to buy. In fact, you're seeing divergence. These divergences could get burned through. We're in a bull run. But as of now, there are negative divergences in place. So where would I buy anytime soon? Pull back to 50.56 or so right there. That's that was a resistance level target that I had. It was hit right here, and it was this previous reaction high and maybe another one. Yeah, some reactions back there. So that is a logical support level. Doesn't guarantee that we get there, but it would be an objective level to buy. If not that, there's your next support. and then down here. So somewhere in there, that would be, if we get a big correction down here, and that's a pretty solid support level. If we get all the way down there to about 46, and again, I'll be doing updates if and when that happens. That would be a really nice level to step in, and it might also be a place for a longer-term trader to put a stop, because I think that level should hold, so a stop somewhat below there. Moving on. Okay, that's JJG. Another component of JJG is wheat. I really like wheat. This is the ETN right here. We've had a lot of swing trades in recent years on wheat. It's just been a very simple wash, rinse, repeat process. This is a support level here. You buy it on pullbacks to 490. You look for positive divergence on those pullbacks, as you had here. And you get out towards the top. We had resistance here, and these were, I've always had my max targets anywhere from T3 up to T4 here in this range. It's in a multi-year, what I believe to be a multi-year basing pattern in wheat, and there's been some great swing trades, and each and every one of these, were the final targets. I mentioned negative divergence at the highs, time to get out, book profits, and we recycled back in on the lows. So, and you could have even shorted those divergent highs and captured a lot of this. So that's our trading range, and boom, we're pushing there right now on the ETN. And I expect, and I said it before on the last pullback, that I didn't think we were going to go back down here. I said I think that we'll probably pull back and ultimately sooner than later go on to break out of this, and I still maintain that. In fact, the chart of wheat futures looks even more constructive. Let me pull that up for you. Here's CW. Big move today. This is just a 2-hour period chart, 6 months, but that's not the one I wanted to show you. Bear with me here. Let's go to this board here. Okay, and here's a long-term chart of wheat. I just love this chart. These are wheat futures, continuous contract. What that means is they just splice all the contracts together. Okay, so here's what we see when we look at the bigger picture. This is going back, this is decades here, 2 decades. We're going back to 2000 right here with this trend line. So what you're looking at is wheat has been and is, like many commodities, in a secular bull market, but coming off a cyclical bear market. A secular bull or bear market is larger. That's the much bigger trend when you go out like decades here. And then when you zoom in, within several years or so, this was a cyclical bull market right there, and this has been a cyclical bear market, which I believe ended here. And you can see this is our long-term secular bull market uptrend line. So the bottom line is wheat prices, when you look at these lows, have been clearly rising. And I pointed this trend line out for years now. It's just been a golden trend line to buy wheat when you pull back. This is, again, our long-term secular bull market trend line. It was last highlighted here. And not only did we pull back to that trend line, providing an objective entry in wheat, and not only was that also horizontal price support. You can see this black line here, the horizontal line. Tons of reactions going back for years. So that was, a scale of 1 to 10, damn close to a 10 for an objective entry. But you also had positive divergence right there on the RSI. And so far, that rally from there, I was pointing out at the time that was about a 40% rally up to resist. I had a resistance line here. It was this previous reaction high. We have these reaction highs, and see this now we've taken out this resistance level, and that is longer term bullish. So a second ago I showed you WEAT, the ETN, and I showed you that we were really at the top of that trading range. But remember, ETNs such as WEAT do a good job, but not a perfect job of tracking those commodity prices. They have expenses they need to pay. There's just slippage, they're rolling futures, things like that. So you really want to look at the commodities or the index, the futures, I should say, not index, the futures. And in that, we have a breakout there. Here's the thing. Sometimes, like for example in GLD, the gold ETF, it's so huge that there is a case of the tail wagging the dog. In other words, you can see if there are enough traders trading an ETN like WEAT, that can cause prices to break out or move up or down depending on inflows or outflows, because those ETNs have to position. If you get a ton of traders buying that ETN, WEAT, money coming in. The company then turns around, they have to buy futures to match up with those inflows they're taking in, and that puts buying pressure, upward pressure on wheat prices. Vice versa if you see a lot of outflows. So all I'm going with that is just to kind of backpedal. I know you guys probably think I'm all over the place here, but it would only help to see WEAT break out. I don't know, and you can look it up, how much money is in this ETN, and I don't think it's huge, and it may not be enough to move wheat prices, but all I can say, it can only help to see WEAT, the ETN, also break out, make a solid breakout above this multi-year trading range, although, as I said, the futures have done so already. There it is. So, and if you're a long-term investor, watch this trend line. If you get another pullback to the trend line at some point you will, most likely, great. But you may not. We rode it here for a while, and then boom, we had a big rally. We hit it here. So far, we've been riding along. We could do something similar here if we see a very, nice rally in the commodities into 2021. Okay, next up, another grain, corn. I mean, just ripping. I mean, again, beautiful charts here. Corn put in this CORN, by the way, easy enough to remember, right, for the ETN, CORN. Beautiful divergent low, positive divergence right there, and we had a beautiful downtrend line. I know, I'm sorry, I speak charts sometimes are like art to me. Like if you're a passionate, art enthusiast. There it was, the breakdown. You had a W-type bottom here, or breakout. I'm sorry, the breakout was right here, and corn prices haven't looked back, and we're almost to my fourth target right now, about 1534. Again, maybe history will prove this to be a bear market rally, but I'm leaning towards the fact that it may be early stage and is likely early stage bull market price action. And here's how corn futures look on a weekly chart. Again, this goes back to 2000, but let's just look here. You had this positive divergence building for quite a while. Up top here, I have the RSI, and you can see the positive divergence and oversold right here. Big divergence, and we've been rallying since. So again, whereas before you did have, you had divergence off here, that was a divergent low. I'll show you. You have to put the line like this. There was your divergence line there, and that led to a rally. Looks like I measured it out, 45% from this divergent low to that high. This is a much larger divergence. The same divergence has only been extended. Therefore, I would expect, and I am expecting, a much larger than a 45. We've already had over a 45% rally, in fact, from that divergent low, because it happened at lower levels, and we're about to that same point. And so what happens here, I had R1 as a resistance zone. We've had a lot of reactions that I'm hitting here with the arrow. This one popped a little bit above it. So to be safe, we're right there now. This is a big level for corn. It's had a heck of a run to get there. Do you chase it right now? No. If you're a trend chaser, you can put an order in, set a stop, and just trail that stop up or let it run. But when you get very extended, we could be looking at a correction here. We're overbought, just like we're overbought here. But never underestimate just how much, if supply demand dynamics have shifted, and everybody wants in commodities now, don't underestimate how far they can go, how overbought. For example, if you sold out of your corn right here when we were overbought, you missed out almost twice the amount of gains at that point. You see, we had a lot more to go. This run in corn back here, we're overbought, and we continue to be overbought. Overbought. That's the RSI. Overbought at this point, and it took this divergence, took that long to finally put a top in and lead to a big correction here. Same thing here. We had a run of from the bottom right here. This was a divergent low. There was a divergent low in corn. From here to here, I measured it out, 316% rally. And here's the thing, you got pretty extended here. There was a pretty healthy correction midpoint, but then boom, a big run. So that's what I'm trying to point out, these runs here. And just to say, as overbought as we are, I have to throw caution to the wind. We're overbought at resistance. We could easily correct, but just as easy, we could just keep going up there. So take it for what it's worth, and again, based on my outlook, I think this is a pretty likely scenario, and any correction here, will may provide us a nice objective entry. I would say back to about this level here, about 380-ish, 385 or so. I see a lot of reactions along there. So I'll continue to do these updates. If this happens, I'll post an update here, and maybe we get a good entry there. And if you already have positions in these commodities, great. It's a little easier for me to add to a position that I already have gains in, like corn and things like that, versus taking a new position here. That would be a lot harder, again, with these near-term overbought conditions. Okay, moving on. We have a few more to go here. I know it's a long video. When I cover all these commodities, there's just so many, and I like to look at different time frames. It takes a little while to get through these. Coffee. This coffee futures right here, long-term chart. And again, you can just wash, rinse, repeat. Look for these divergent lows and divergent highs to swing the major trends in coffee. So last time here we had a divergent high that led to this drop, but most recently I highlighted back here in 2019 we put in a divergent low, and we also did it, and there's pretty good support around the $1 level, long-term support in coffee. We undershot it briefly, got back above it, and that's again been a big level in the past where coffee prices have rallied when they hit that level. So again, the case I'm making, and I laid it out way back here in 2019, I listed 3 targets. One of them's buried behind here. It's about the 230 level. This one I was calling for a roughly 60% rally. We hit it. We went on to break out. We got our buy point right here on the breakout of this bullish falling wedge. Rallied, hit my target for a 61% gain there. At the time, I said good time to exit, pulled back, and that target was already hit. We've been making higher lows since, so my expectation is the next time we get there, we could have a reaction on it, or we could go right on through it because we've already checked that target that's been hit once. And that's usually where I expect on the initial tag of each target, I expect a reaction followed by a move up. And so my next target's up here around 170 on coffee futures, and then ultimately 230 would be the next target after that. So that leaves a lot of upside potential in coffee. And again, it's been moving higher. Keep it very simple. This is an uptrend, a series of higher lows, and we need to make that a higher high to say, hey, we have the early makings of a new uptrend. So that's what I'm looking for on coffee. And lately I've been covering the KC, the coffee futures contract. Right here, this is what it looks like on a 120-minute chart. Every candlestick is 2 hours of trading, and you had, we had a divergent high right here recently, just like we had a divergent low here. There was bullish breakout of the bullish falling wedge, and this divergence has led to a correction. But this is more indicative of bull market action, having a relatively minor correction. I always say there's 2 ways a stock can correct or a security can correct, or a combination of those 2, and that is either in price, that would be a correction in price, or time. This is mostly a correction in time. It's sideways trading. So if we can power on through there, that would satisfy those divergences, and maybe we get the next leg up. Basically, we have to take out these recent highs right here around the top of the trading range. Okay, NIB is the cocoa ETN. We'll just look at this chart. Beautiful uptrend line, last highlighted right here is an objective long entry. You had not only a pullback to the uptrend line, but you had positive divergence on your indicators, and that's it. We've been moving higher highs, higher lows. Not much else to say other than a break above this 35-ish level. A lot of key reactions there. Boom, that would be longer term bullish, and that is my outlook for NIB. If and when we get back to that trend line, if the charts confirm at the time, that may offer another objective entry. Although, sometimes you can get really quite a bit, away from the trend line before you come back and check it. So, I wouldn't be holding out for a pullback there. If and when we get there again, we'll look at the chart, see if it's worth it. But I'm kind of leaning towards this scenario here. Okay, and then DBA, one size fits all. If you want to invest in agricultural commodities, there it is. Finally took out, I don't know, oh, here it is. There's my other chart. Basing pattern there, highlight at the time, positive divergence at the lows right here, and DBA is up, and that's since June. We've rallied about 21%. Remember, you're going to be held back. The more diversified you are, whether it's a stock fund, with the S&P 500, 500 components, or a more concentrated fund that only maybe some mutual funds only have 10 or 20 stocks, the fewer positions you have, the higher gain potential, but also the higher loss potential. And that's what, people love the S&P 500 because you have 11 different sectors, 500 companies, and but what it'll do, it'll hold back your returns. Same thing when you go with a one-size-fits-all ETF. Why? Because you had, for example, I talked about it earlier, lean hogs and feeder cattle and live cattle make up a certain amount. They've been lagging behind because the grains have been strong, and so they've held back the performance. But again, maybe all of a sudden the grains correct and then cattle rallies. So when you have this, you can see it smooths out the bumps. And again, this is like I said, it's my term, one size fits all if you want agricultural commodities. You're not going to have oil, gas, gold, and copper and other things in here. We do have that. Let me just wrap the video up because we've covered all the individual commodities. These are some of the other ones. GCC, Wisdom Tree Continuous Commodity Index Fund. This one has precious metals, energy in there, natural gas, oil, grain, softs, you name it. So there's a more of a one-size-fits-all. I've covered copper quite a bit recently. I'm bearish on copper right now. And then what else? DGP, another commodities ETN. The ones that have oil particularly, I think, are poised maybe to underperform if and when oil moves back down to the bottom of that trading range. But I just wanted to throw out some of the various ETNs. And then MOO, agribusiness. So this is not agricultural commodities, rather companies such as John Deere, Archer's, Daniel Midland, companies like that are in that agriculture arena. So if the stock market corrects, this one's likely to fall more than those other commodity tracking ETNs because this has individual stocks. We'll wrap it up here and get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.